It looks like a boom, but inside, it's a ghost town. In 2026, Texas is running into a problem that doesn't care about slogans. It doesn't care about optimism. It cares about deadlines. This is the Texas doom loop, a commercial real estate crash that starts with empty offices and ends with the banks. There's a phrase financiers are whispering like a curse, the maturity wall. It means a huge stack of commercial real estate that is coming due, and refinancing it is no longer automatic. Rates are higher, values are lower, and many buildings simply don't earn enough to justify the old price tag. The warning signs are already here. Loans that should have been paid off are getting stuck. Extensions are harder. Buyers want discounts, and the market is filling up with properties that don't trade because nobody can agree on what they're worth anymore. Regulators have been warning about this exact setup. Refinancing gets harder when interest rates are high and property values are falling, especially for banks with heavy exposure to commercial real estate. So tonight, we're going inside the towers of Dallas and Houston. We're going inside the debt. And then we're going inside the balance sheets of the regional banks holding the bag. Because if you want to understand the next credit crunch, you don't start on Wall Street. You start in a half-empty skyscraper in Texas. Commercial real estate lives and dies by one number: occupancy. If tenants leave, cash flow dies. And when cash flow dies, debt becomes toxic. In Dallas, the office problem isn't coming. It's here. Vacancy in the urban core has reached levels that should stop a market in its tracks. When a downtown has a third of its office space sitting empty, it's not a normal cycle, it's a structural wound. In Houston, the story is different, but the outcome rhymes. Major submarkets are bleeding tenants at levels that destroy pricing power. Landlords lose leverage, tenants gain it, and the market becomes a slow-motion price collapse. Now, Texas boosters will say vacancy is normal, cities rotate, markets cycle. And yes, vacancy exists everywhere, but what's happening here behaves like a virus. It spreads in three ways. First, companies shrink space. Second, companies delay renewals. Third, companies demand concessions so extreme that landlords stop pretending this is a healthy market. And here's the cruel part. The skyline still grows, towers still look new, cranes still exist. So from the outside, it looks like Texas is winning. But inside, the buildings are being hollowed out. Developers didn't stop building just because demand changed. They kept going because the financing machine kept going. Cheap money trained the market to believe one idea: if you build it, tenants will come. Now, the tenants aren't coming fast enough, and that gap is where the doom loop begins. Vacancy is the disease. The maturity wall is the moment the disease becomes fatal. Here's the basic mechanics. Most office towers aren't owned the way you own a house. They're owned like a leveraged trade, a stack of debt, a stack of assumptions, a bet that the future will be stable. And for years, stability was easy to assume because refinancing was easy. But now the refinance math is brutal. A building that was worth one number a few years ago can be worth far less today. When occupancy is down, income is down. When income is down, appraised value drops. When value drops, the lender demands more equity to refinance. And if you don't have that equity, you have two choices: pay down the loan with cash you don't have, or default. This is why you're hearing about owners handing back the keys. Sometimes it's strategic, sometimes it's desperation, sometimes it's survival. And it happens when the loan comes due, not when the news cycle decides it's scary. A maturity isn't a headline, it's a deadline. Now, you might think, okay, landlords lose, investors lose, big city problem. No, because the debt doesn't vanish when the building value collapses. It moves. It moves onto the lender. And in Texas, the lender is often not a mega bank in New York. It's your regional bank. This is the part that scares regulators. Regional and community banks are deeply tied to commercial real estate.
They are the plumbing of local credit. They finance office buildings, they finance retail centers, they finance construction, and most importantly, they finance small businesses that rely on credit lines to survive. When banks are heavily concentrated in commercial real estate, a downturn doesn't just hurt, it spreads. And the nightmare scenario is simple. A landlord can survive a bad year. A landlord can survive concessions. A landlord can survive vacancies. But when the loan matures, survival requires refinancing. If refinancing fails, the loan becomes impaired. If enough loans become impaired, the bank's capital gets eaten. And once capital gets eaten, the bank stops lending. That's how a commercial real estate problem becomes a 2008 credit crunch at the local level. You don't need a national banking collapse for this to hurt. You only need local banks to pull back. And Texas is uniquely vulnerable to a local credit freeze because its growth story depended on easy credit. When banks get nervous, they stop saying yes. They tighten underwriting, they cut credit lines, they raise pricing, they move slower. And small businesses feel it first because small businesses run on oxygen. That oxygen is credit. A restaurant needs a line to survive slow months. A contractor needs financing for equipment. A retailer needs inventory credit. A medical practice needs working capital. When credit tightens, the real economy tightens. Now add another ingredient, downtown tax revenue. Because when office values fall, cities don't just lose foot traffic, they lose revenue. And when cities lose revenue, they cut services. And when services decline, downtown becomes less attractive, which means even fewer tenants. That's the doom loop. Downtowns are ecosystems. Workers are the fuel. Office towers are the engine. When workers don't show up, everything downstream starves. Restaurants, coffee shops, gyms, dry cleaners, parking garages, even transit systems that depend on daily commuters. And this is where the human cost becomes visible. A small business can't survive on memories of lunch rush. A cafe owner doesn't pay rent with a skyline photo. They pay rent with customers. When office floors go dark, street-level stores go dark next. And as downtown weakens, the vacancies feed themselves. Vacancy rises, landlords slash rents or offer extreme concessions, property values drop, refinancing fails at the maturity wall, defaults rise, banks take losses, banks pull back credit, small businesses lose lifelines, downtown gets emptier, and then vacancy rises again. This is why it's called a doom loop, because each problem feeds the next. Now the question every viewer should be asking is simple. What happens next, and what do you do with your money? No one can promise you whether there will be bailouts, but regulators are clearly watching commercial real estate risk, especially refinancing stress and bank concentration. So in 2026, the smart move is not panic, it's clarity. First, understand where your bank sits. Is it a mega bank with diversified revenue and low concentration in commercial real estate, or a regional or community bank where commercial real estate is a large chunk of the balance sheet? Second, don't confuse high interest on deposits with safety. Banks can offer attractive rates while quietly sitting on a portfolio that becomes impaired if commercial real estate values reset again. Third, diversify your cash. Not because you're panicking, because you're managing risk. If you're a business owner, assume credit will tighten, because when banks get hit, the first thing they protect is themselves, and the last thing they extend is a new loan to a small business. Finally, remember this: the towers don't fall dramatically, they don't crumble on camera, they empty out quietly, they refinance quietly, they default quietly. And then, one day, the city wakes up and realizes the boom was real on the outside and hollow on the inside. It looks like a boom, but inside, it's a ghost town. And if the maturity wall hits harder than expected, Texas won't just face empty skyscrapers, it could face empty banks.